expecting stocks to rally going into next year, but I'm seeing something that can make the market pump its brakes. There are two major events happening with about a week apart that could determine the market's fate. And the first one is the Federal Reserve meeting happening between December 9th and December 10th. The Federal Reserve is expected to cut interest rates by a quarter percentage point, and this is drastically different than where we were a few weeks ago. Before, there was only a 30% chance that the Fed would be cutting rates, and since then that's jumped to over 80%. The reason being is because the Fed has a dual mandate. They're responsible for keeping prices stable, but also keeping unemployment low. Now, the Fed won't be getting inflation data for November until after their meeting, meaning the only data that they do have is data showing massive layoffs amongst these corporations, which could increase unemployment, which means that they're choosing to cut rates, or at least there's a good chance for them to cut rates because they're addressing the issue they can see rather than the one that they can't. Now, typically rate cuts are great for stocks, especially tech stocks, but there's something else happening that could halt that rally, and that is the Bank of Japan meeting, which is happening between December 18th and December 19th. Now, the Bank of Japan is expected to raise their interest rates by a quarter percentage point or even a half percentage point. This is really bad for tech stocks because it's something called the yen carry trade. This is essentially where American investors borrow money in yen, which is Japan's currency, and the yen is typically valued less than $1. American investors use that money to buy American assets to increase their profits, and they pay back the loans with the profits from their investments. Think of Japan as America's sugar daddy, right? They've given us free money for years whenever we've asked for it, and Japan is also the largest holder of US debt. But when Japan raises their rates, their currency becomes more valuable compared to dollars. This increases the loan payments and forces people to sell the stocks they bought with those loans. This happened back in August 2024, triggering a sell-off, and it happened again the week before Thanksgiving, triggering another intraday sell-off. So here's my take. The Fed is expected to lower interest rates, and they just pumped $13.5 billion into the banking system. That means the value of cash will go down and the value of assets will go up, which could trigger a short-term rally, right? But if the Bank of Japan decides to raise its interest rates, all of that could become undone, and we could see a lot of red at the back half of the year going into next year. Now, this doesn't mean that you should sell your stocks, but it does mean that this isn't the time to be making any risky bets. In fact, this is when you should be doing something called hedging. That's when you buy assets that are completely uncorrelated to the ones that are at risk. So what does that look like? My portfolio has a lot of tech stocks, which would do really bad if the Bank of Japan decides to cut their rates. So I've been buying call options on gold, which typically does well when risky assets like stocks don't do well. Let me know what you guys think in the comments. Do you guys see the market rallying through year end, or do you guys think we have a pullback in store? Stay informed and stay invested. I'm gonna catch y'all next time. Peace.